So three key factors have been driving markets so far this year and this quarter as well. Rate expectations around politics, as well as trade. Now with respect to trade, actually through the first quarter of the year into April, it was looking like trade negotiations between the US and China were proceeding in a fairly favorable manner. It looked like we may actually get some sort of resolution. That all changed in dramatic fashion at the beginning of May, with both sides walking away from the negotiations table. This led to a sell-off in risky markets such as stocks. At the same time, we saw an inflow into bond markets and the safety that was provided there. Brexit continues to occupy the minds of European investors. This quarter, we saw risks around Brexit increase. Theresa May, the Prime Minister of the UK, failed on a third attempt to have her negotiated plan passed by Parliament, actually stepped down and paved the way for a leadership battle for the new Prime Minister. Now, Boris Johnson looks to be leading as a candidate in this regard, and all indications are that he would be in favor of a more deliberate negotiation with the EU, taking a harder approach, potentially increasing the odds for a hard Brexit, a case where Britain falls out of the European Union without a negotiated settlement. So rate expectations have evolved significantly over the course of this year, beginning with the Federal Reserve in the US. If you go back to the end of 2018, 2 rate hikes were actually being priced in for this year by the markets. Fast forward to today, we're actually seeing 2, maybe 3 rate cuts being priced by the market. Now, as we had the trade issues unfolding over the course of May, more and more rate hikes, and with greater probability, was being priced into the market. The idea that the central bank would come in and support markets if there was a risky factor coming out of trade. Over the course of June, then we saw cooler inflation data, somewhat softening economic data. Again, the market actually cheered the softer data with the concept that this would allow the central bank room to actually deliver on these rate cuts that have now been priced in. Risky markets have actually taken off over the course of June, and now where we are today, roughly at all-time highs. Trade and politics are sure to provide some headline risk for the remainder of this year. However, we believe that rate expectations will be the dominant driver. Today, markets are expecting significant easing from central banks, particularly the Fed in the US, whereas the Fed's own projections far closer to neutral in terms of what they expect to deliver. Bridging the gap between these two sets of expectations is sure to cause some volatility in markets and really test the Fed's ability to clearly communicate their plan without causing a sell-off in stock markets.